Three insurance syndicates make simultaneous announcements at 0900 GMT. Lloyd's of London, American International Group. Allianz Global. Red Sea transit coverage is terminated effective immediately. All active policies are void within 24 hours. 840 vessels currently in the Red Sea receive notifications in real time. Your insurance is canceled. Continue at your own risk. No missiles launched, no ships attacked. But the Red Sea closes anyway, not by military blockade, by spreadsheets and actuarial tables. Three underwriters in London, New York, and Munich just achieved what naval forces could not. Complete shutdown of commercial traffic through one of the world's most critical choke points. Sea Doctrine reveals who really controls the seas, admirals or accountants. The announcement hits shipping companies like a coordinated strike. 47 major carriers receive identical notifications. Marine hull insurance canceled. Cargo liability coverage terminated. Protection and indemnity clubs suspend memberships. War risk premiums are no longer available at any price. The insurance industry has declared the Red Sea uninsurable. This is not a gradual increase in rates. This is total market withdrawal. Underwriters are not willing to accept Red Sea risk under any financial terms. When insurance refuses to price risk, the risk is considered infinite. No rational company operates in infinite risk environments. Maersk receives the notification at 0903 GMT. The company has 62 vessels in the Red Sea or approaching the Suez Canal. Combined cargo value, $8.4 billion. Combined vessel value, $3.2 billion. Total exposure, $11.6 billion. All of it uninsured in 24 hours. The CEO convenes emergency board meeting. The decision is binary. Continue operations and accept total financial exposure, or suspend Red Sea transits immediately. There is no middle option. Insurance is not negotiable. Banks that finance shipping operations require coverage. Letters of credit demand valid policies. Port authorities verify insurance before allowing vessels to dock. Without insurance, ships cannot operate legally or commercially. The board meeting lasts 18 minutes. Decision: all vessels currently in Red Sea are ordered to reverse course immediately. All scheduled transits are canceled. Red Sea operations are suspended indefinitely. Maersk is not alone. MSC makes identical decision at 0921 GMT. CMA CGM follows at 0934. Hapag-Lloyd announces suspension at 0947. Within 2 hours of the insurance cancellation, the 4 largest container shipping companies in the world have ceased Red Sea operations. This represents 43% of global container capacity. The cascading effect is instantaneous. Trade routes, missiles, and war. Red Sea Doctrine. 840 ships receive new orders. Turn around. Find alternate routes. Do not proceed through Red Sea under any circumstances. Captains who have spent careers following company procedures now face direct conflict. Their vessels are already committed to Suez Canal transit. Cargo is contracted for delivery via the shortest route. Customers expect arrival dates based on Red Sea passage. Reversing course adds 3 weeks to journey. Rerouting around Africa costs hundreds of thousands in additional fuel. Delays trigger penalty clauses in shipping contracts. But none of that matters if the ship is uninsured. One incident and the company faces unlimited liability. One attack and the vessel becomes total loss with no compensation. One crew casualty and wrongful death lawsuits bankrupt the operation. The mathematics are brutal. Certain delay and financial penalty versus potential catastrophic loss. Companies choose certainty. The reversal begins. Container ships turn south. Bulk carriers abort northbound transit. Tankers divert to alternate routes. Within 6 hours of the insurance announcement, vessel traffic through Bab el Mandeb drops 68%. By hour 12, it drops 89%. By hour 24, the Red Sea is effectively empty of commercial shipping. No military force achieved this. 3 insurance companies did. Red Sea Doctrine examines the power structure that emerges. Naval supremacy means nothing if ships cannot legally operate. Carrier strike groups cannot compel insurance coverage. Destroyers cannot underwrite policies. Military presence is irrelevant when financial markets declare a zone too dangerous to insure. This is the reality of modern maritime power. Economic gatekeepers control access more effectively than any navy. The insurance decision is based on actuarial analysis. Lloyd's risk assessment team calculated expected losses for Red Sea operations. Number of transits per month, 4,200. Average vessel value, $40 million. Average cargo value, $60 million. Probability of total loss incident, 0.8% per month. Expected monthly loss, $336 million. Current premium income from Red Sea coverage, $85 million per month. The equation is simple. Expected losses exceed premium income by factor of 4. Continuing coverage guarantees bankruptcy. Underwriters cannot price policies high enough to cover the risk because shipping companies would not pay premiums that high. The market fails. Coverage disappears. When insurance companies conclude they cannot profitably cover a risk, that risk becomes commercially impossible. Shipping requires insurance. Insurance requires profitable risk pricing. Red Sea risk cannot be profitably priced. Therefore, Red Sea shipping stops. The logic is mathematical. The effect is total. Who decides what waters are navigable? A. Navies with guns. B. Underwriters with spreadsheets. Comment which has more power. Egypt faces immediate economic catastrophe. Suez Canal generates $6.3 billion annually. Revenue comes from transit fees. But if ships do not transit, there are no fees. Canal Authority projects 92% revenue loss within 1 week. $6 billion disappearing from national economy creates political crisis. Egypt requests emergency meetings with insurance syndicates. Government offers to underwrite policies directly. State backing for marine insurance. But insurance companies refuse. Government guarantees are only as reliable as government solvency. If multiple ships are lost, can Egypt pay billions in claims? Insurance actuaries calculate Egyptian government cannot credibly backstop the risk. State guarantee is rejected. Canal revenue continues collapsing. Shipping companies trapped in the middle face impossible logistics. Cargo already loaded for Red Sea delivery cannot be unloaded mid-ocean. Contracts specify delivery ports. Customers demand their goods, but the ships carrying those goods cannot complete transit without insurance. Companies negotiate emergency contract modifications. Force majeure clauses are invoked. Delivery obligations are suspended. Customers file breach of contract lawsuits. Legal battles will continue for years. But immediate problem is 840 ships sitting in ocean with canceled insurance and nowhere to go. Some companies choose to risk it. Smaller operators without major financing requirements. Ships owned outright with no bank loans. Cargo owners willing to self-insure. These vessels continue Red Sea operations. The insurance is gone, but the route still exists. Some captains will sail uninsured waters if the price is right. The price becomes astronomical. Freight rates for Red Sea transit increase 400% overnight. Customers desperate for delivery pay premium costs. Shipping companies willing to accept total risk demand total premium. The market bifurcates. Insured shipping uses safe routes around Africa. Uninsured shipping uses dangerous route through Red Sea. Two-tier system emerges. Legitimate commerce versus risk-tolerant operators. Red Sea Doctrine shows you what happens when financial markets fragment. Legal shipping slows to crawl. Gray market shipping accelerates. Vessels operating without insurance care less about regulations. Ships willing to take total risk are willing to take other risks. Safety standards decline. Crew quality decreases. Maintenance is deferred. The uninsured Red Sea fleet becomes progressively more dangerous, not from external threats but from internal degradation. When ships operate outside normal financial frameworks, they operate outside normal safety frameworks too. Insurance companies monitor the situation. Actuaries calculate that uninsured ships have higher incident rates. Mechanical failures increase. Crew errors multiply. The uninsured fleet experiences 3 times normal accident rate within first month. This validates the original decision to cancel coverage. The Red Sea is too dangerous. Even without military attacks, the operational risk exceeds acceptable parameters. Ships break down. Crews make mistakes. Uninsured vessels sink from causes that proper insurance would have prevented through mandatory safety standards. 63 days after insurance cancellation, the first major incident occurs. Uninsured bulk carrier suffers engine failure in Bab el-Mandeb. The ship is dead in the water in the narrowest section of the strait. Tugboat assistance is requested, but the vessel has no insurance to pay for salvage. Salvage companies demand cash payment up front, $2 million to tow the ship to safe anchorage. The ship owner does not have $2 million in liquid assets. The vessel sits blocking traffic. Other uninsured ships navigate around it. The risk compounds. Navigation becomes hazardous. Collision probability increases. Insurance companies observe this and recalculate. Even if Red Sea stabilizes politically, the operational environment has degraded. Uninsured shipping creates hazards that affect everyone. The zone is now dangerous for reasons beyond military threats. Coverage will not return until professional standards return. But professional standards require insurance. The cycle is self-reinforcing. Lack of insurance degrades operations. Degraded operations justify lack of insurance. Red Sea shipping spirals downward. Governments attempt intervention. United States proposes naval convoy system. Military escorts for commercial vessels. Protection reduces risk. Risk reduction should enable insurance. But insurance companies analyze convoy effectiveness. Naval escorts protect against military attack. They do not prevent mechanical failure. They do not reduce crew error. They do not guarantee safe operations. Convoy system addresses wrong risk. Insurance still unavailable. European Union offers to create government-backed insurance pool. Centralized coverage funded by member states. Underwrite the risk that private markets will not accept. The proposal requires ratification by all member parliaments. Legal framework takes 6 months minimum. Meanwhile, ships need insurance now. The government solution is too slow. Private markets have already moved on. But what happened inside the shipping corridor shocked commanders. 2 insurance syndicates quietly begin offering limited Red Sea coverage again. Not to commercial shipping, to military vessels, naval auxiliaries, government-chartered ships. The coverage is narrow. Premiums are extreme, but it exists. Red Sea Doctrine reveals the calculation. Insuring military vessels is different from insuring commercial ships. Navies do not maximize profit, minimize risk through superior training and equipment. Military operational standards exceed commercial standards. Incident rates are lower. Insurance math changes. Coverage becomes possible at price governments will pay. Civilian shipping companies protest. If military vessels can be insured, why not commercial ships? Insurance companies explain the actuarial difference. Naval crews are extensively trained. Military vessels are maintained to higher standards. Government operations accept losses civilian companies will not. The risk profiles are incomparable. Commercial shipping remains uninsurable. The protest achieves nothing. Economic pressure builds across global supply chains. Goods that normally transit Red Sea now route around Africa. 3 additional weeks of shipping time, 40% higher transport costs, delays cascade through manufacturing, just-in-time inventory systems fail, factories shut down waiting for components, retail shelves empty as products are delayed, consumer prices increase as shipping costs are passed through. The economic damage from insurance cancellation exceeds the damage from actual military incidents. Perception of risk is more disruptive than reality of danger. 3 insurance companies created more strategic effect than naval blockade could achieve. Markets recognize the new dynamic. Insurance industry has veto power over maritime commerce. Underwriters can close any waterway by declaring it uninsurable. This power is more absolute than military force. Navies can be challenged. Insurance decisions cannot. When Lloyd's says no shipping stops, is this the start of a wider naval war? Comment Y or N. 90 days after cancellation, some shipping companies adapt. They create captive insurance subsidiaries, self-insurance structures. Companies with large enough fleets pool their own risk. If you operate 200 ships, you can statistically absorb loss of 2 per year. Create internal reserve fund. Cover your own risks. Bypass external insurance market. The largest shipping companies implement this strategy. Maersk creates self-insurance vehicle. MSC establishes captive reinsurance company. They are large enough to be their own insurers. Red Sea operations resume, but only for the giants. Small and medium shipping companies cannot self-insure. They lack the fleet size to statistically manage risk. They lack the capital reserves to absorb total losses. They remain locked out of Red Sea operations. The market consolidates. Large companies with self-insurance capture market share. Small companies without coverage lose business. The insurance cancellation becomes competitive weapon. Survivors emerge stronger. Casualties disappear. Red Sea Doctrine tracks the permanent changes. Insurance industry demonstrated power to close strategic waterways. Shipping industry adapted by concentrating ownership. Naval forces proved irrelevant to commercial decisions. The lesson is absorbed globally. Future maritime conflicts will target insurance markets, undermine coverage and shipping stops without firing shots. This is economic warfare in purest form. Make the route uninsurable and victory is achieved. Traditional naval blockade is obsolete. Modern blockade is actuarial. 3 syndicates, 24 hours, 840 ships. The Red Sea closed more effectively than any military operation could accomplish, and it stays closed until spreadsheets say otherwise. No admiral decides this. No politician controls it. 3 chief risk officers in 3 insurance companies hold veto power over 12% of global trade. This is who controls the seas, not the nation with most warships, the industry with best risk models. Red Sea Doctrine shows you power that operates in shadows, financial markets that move navies, actuarial tables that close choke points, insurance decides which waters are navigable and which are not. What breaks next? Trade, diplomacy, or deterrence? Will insurance markets permanently reshape global shipping routes, or can coverage be restored? Can commercial shipping operate in politically unstable regions, or has financial risk become the ultimate strategic weapon? Subscribe to Red Sea Doctrine, where sea power decides everything.